All right, guys, welcome back for another video. In today's video, I want to talk about crypto lending as well as the basics of analyzing a company's balance sheet. If you guys aren't familiar with this website, Arcane Research, I highly recommend it. They've got some great material here. This article in particular caught my eye. It's titled "Survival of the Fittest." Basically, they're analyzing the different balance sheets of different major Bitcoin miners in the space. The Bitcoin market's matured pretty considerably, and it's got to the point where a lot of these Bitcoin miners are publicly traded companies. So anybody can, go on, find their balance sheet. It's publicly listed, and look at the balance sheet for themselves. I think in crypto, the Bitcoin miners actually represent the least risky borrower, just from the sense that they have a constant stream of cash flow. Right? And they don't really have a lot of exposure to the underlying collateral that would be Bitcoin in this situation, because their exposure to Bitcoin is, not exposed to the same level of volatility as, say, a fund that was trading directionally. Because miners are just constantly mining blocks, acquiring Bitcoin, and constantly averaging their cost basis. They don't experience volatility in the way that a directional fund would. And then they don't run into the same problem as a directional fund would, have the underlying collateral to their loan in the form of Bitcoin that drops further than the lender or the borrower expected, and then further hampering their ability to meet their debt service obligations. Um, you know, uh, Bitcoin miners are shielded from volatility in that way, and so are exchanges if they're run well. Exchanges, they make their money from fees. So regardless of what if the Bitcoin goes up or down, right? They're not their cash flow is not based on the direction of the underlying collateral. That's what I'm trying to get at. When you have a situation where the cash flow is, going to be impaired if the underlying collateral is also impaired, then you have a serious situation as a borrower. But anyway, long way of saying that, exchanges and Bitcoin miners are the most risk-free borrowers that you could find as a lender. And really, credit analysis is the risk analysis of a borrower at the end of the day. And I just think, as we dive into the balance sheet analysis, I think it's really helpful to come at it from the perspective of a lender, because really lenders are, in my opinion, the most dialed into the actual risk that exists. Um, and typically we look at the markets from the perspective of a borrower, if we're not in lending operations or anything like that. Um, so anyway, this is Coinbase's uh, balance sheet. I was looking on Twitter and I saw a lot of FUD and different rumors about Coinbase being insolvent. This is probably spurred in the wake of the different insolvencies that happened on these different lending platforms like Celsius, BlockFi, things like that. But it kind of preys on the ignorance of people, right? I mean, people can just download Coinbase's balance sheet and see for themselves that the company is not insolvent, right? So I guess people spreading FUD don't think that people will go look at the balance sheet that's publicly available. I'm not sure, but anyway, this is Coinbase's balance sheet, and you can see it's a pretty healthy balance sheet with current assets, uh, essentially cash and cash equivalents at 6 million, right? Or excuse me, 6 billion right here. This is in thousands. So that's 6 billion in cash. Customer custodial funds, 10 billion. Total current assets, 16 billion. So it looks like and here's the crypto assets held on their balance sheet. So this is the company's assets held on their balance sheet, not customer custodial funds. Um, so that's an important distinction. And generally, you know, if you just look at this balance sheet, you can see that they're well positioned. Relatively little debt, uh, and the debt that they do have on their balance sheet is long term debt. So generally, a lot of companies that get in trouble, they have a significant amount of short term debt. But just if you look at the step back and scope out the total assets in relationship to total liabilities, this company is pretty damn far from being insolvent. Anyway, I'll just jump into the basics of balance sheet analysis. So, whenever you're analyzing a balance sheet, cash flow is the most important thing you can look at. That's why it's listed at the top of the balance sheet. And really, what the cash flow represents is the borrower's ability to fulfill its financial obligations. Because remember, all the loans and all the financing they're taking is denominated in USD. So they need USD to meet their obligations. So cash flow is the most important, but collateral is also extremely important. And collateral is just the assets that the lender can take possession of in the event of default. Business assets and the assets of guarantors are considered a secondary source of repayment. And also, the character of the borrower will be taken into account. You know, if certain people have a certain reputation, that'll be considered. Uh, you know, really, what you want to, on a broad level, look for is the cash flow that a company generates greater than its debt service requirements, right? Because if a company is not able to generate the cash flow to meet its debt service or meet its obligations broadly, that company is insolvent. So all these companies operate on generally accepted accounting principles to ensure that all financial statements follow the same set of rules. Now, the actual categories of those financial statements are not as important as just understanding that that these financial statements follow the same format, and they're all eventually linked back into USD in cash flow analysis. And I think the one important point is that whenever you're looking at a financial statement, you want to look at something that is at least 12 months old or spans a period of roughly, you know, that is at least over a month old, or excuse me, over a year old, or spans the prior 12-month period, just because it gives you a full understanding of the balance sheet. And this is actually not a great example of that because you're not seeing the fully audited 12-month period. Really, ideally, if you were analyzing the balance sheet, that's what you'd want to look at because a lot of companies clean up their balance sheet around the end of year and around the quarterly opens and closes. To a lesser extent, I upload a video on the quarterly opens and closes. If you haven't seen that, check it out. I think it's titled Quarterly Opens and Closes, and it give you a framework for why those areas serve as a pivot in the market generally. This is sort of the underlying reason, and of course, it's going to correlate with the institutional involvement because this is just the time schedule that a lot of institutions operate on. Again, I know Coinbase is not necessarily a directional based company setting crypto prices, but the same principles apply to those directional based funds. And I would say that basically what you want to look at in calculating a borrower's financial ability is calculating their current, long-term, and total assets for the most recent 3 years. Assets represent a company's use of cash. They are listed in descending order on a balance sheet from the assets most like cash itself, to those least like cash, fixed or slow assets with low liquidity. After a creditor has provided a company with cash, the company uses the cash to purchase other assets. Purchasing assets threatens a company's survival because cash is no longer available to pay other obligations. Unfortunately, the only way to make a profit is to acquire assets to produce the commodities the company is selling. From the lender's perspective, depleting cash from a balance sheet is a necessary evil. Current assets can be converted into cash within 12 months. They are listed from the most like cash to the least like cash on the balance sheet and are broken down in the following categories: cash, accounts receivable, inventory, notes receivable, prepaid expenses, other current assets. Cash, accounts receivable, and inventory are the three most common assets on a balance sheet. If the company doesn't have enough cash to meet its liabilities, it's insolvent. And there are really three uses of cash: buying fixed assets, purchasing working capital, and paying obligations. But paying obligations is the most important function of cash. This can further be broken down into trade creditors, taxes, employees, professional lenders, and stockholders, all representing liabilities, or obligations to the company. Buying fixed assets is actually the most risky use of cash because the cash hoped to be produced by these assets will not materialize on the company's financial statements until at least 12 months after the assets are acquired. This can be especially risky if the lender has borrowed excessive short-term capital. Again, in the case of Coinbase here, we don't see that, and that's one of the factors that led us to think that this is a very solid balance sheet, as well as the huge amount of cash flow. So, the trick to sound financial management is matching the timing of the cash flow so that the cash flow is highest when the obligations are due. If liabilities come due before cash is realized, a company could or will go bankrupt. Accounts receivable are dollars due from customers and are proportional to sales. They are matched by invoices and arise from the operating cycle process of selling inventory or services on terms that allow delivery prior to the collection of the cash. Inventory is sold and shipped, an invoice is sent to the customer, and later cash is collected. The receivable exists for the time period between the selling of the inventory or the provision of the services and the receipt of cash in payment for the invoice. An impairment in the ability to collect accounts receivable payments can impair a company's cash flow. Accounts receivables are effectively loans issued to the customers at no interest. Allowing accounts receivables to grow too large can impair a company's balance sheet. Some companies will even offer a small discount or incentive for customers to repay receivables within a certain time period. Inventory is goods or products sold to make a profit. Purchasing inventory is the first use of cash in a business operating cycle. These purchases are made possible with funds sourced from accounts payable, meaning that the company has a net term payment obligation to the inventory suppliers. But inventory can be manipulated. A company can inflate or deflate its profits margin, particularly through inventory manipulation. Because cost of goods is the way companies calculate their profits, inventory manipulation occurs when a company's ending inventory is manipulated. Manipulation can cause a company to look more profitable than it is when seeking bank financing, or to look less profitable when it's paying taxes. Notes receivable represent loans made from the company to a third party. They should be included in the total current assets if the note is due within 12 months and is listed in the long-term assets if the payment term is longer than 12 months. Notes receivables are generally red flags on the balance sheets of company because making loans is the business of banks in the public sector, not operating businesses trying to generate a profit. The worst type of note is one issued to an officer of a company. This is a bookkeeping method to try to increase officers' net pay without affecting the net worth of the company. Prepaid expenses are uses of cash to purchase a good or service that will be received within the next 12 months. This can include rent, insurance, subscriptions. Prepaid expenses generally represent the smallest uses of cash in the current assets category. Other current assets consist of small deposits or receivables such as interest income or rents due to a company. Rents due and tax refunds are generally red flags on a company's balance sheet if you see them. Rents due can be notes receivables in disguise. Tax refunds are a red flag because every business makes quarterly tax payments based on estimated profits. If there is a tax refund, it means the company paid a high amount in anticipation of a profitable year. If the first 6 months of the year were good, but sales slumped during the last 6 months, triggering a refund, the lender would want to find out why there was a decline. Long-term assets take at least 12 months to be converted into cash and are some of the following asset categories: net fixed assets, notes receivable, investment in subsidiaries, intangibles, and other assets. Long-term assets are the assets that are least similar to cash. Long-term assets can impact cash flow when there is a mismatch between sources and uses of cash. This is a long way of saying that long-term assets should be financed with long-term debt. Again, remember that companies get into trouble when they take on too much short-term debt. Net fixed assets are assets with a useful life of more than a year. Common examples include land, buildings, machinery, and leasehold improvements. With the exception of land, all other fixed assets depreciate. As assets depreciate, they slowly mature into cash. Net fixed assets is calculated by subtracting the accumulated depreciation value from the original cost of the asset. So this is basically ties into why real estate is not a great investment over the long term. Uh, Again, you can't separate the land from the house because the land actually can be a good investment because right, land doesn't depreciate in value. It can appreciate pretty substantially actually. But if you were to just talk about the house itself, if you exclude the land, it's resting on, is a depreciating asset. So it may go up in nominal terms, um, but in real terms, right, its value will never maintain the same purchasing power in real terms because the it's a depreciating asset. There are repairs that need to be made on the house, and in general, you're going to pay a substantial amount of repairs over a long period of time. Now, investment into subsidiaries represents cash used for a loan or a stock purchase to affiliates. The investment as the loan matures into cash as the loan becomes payable. As a stock purchase, the investment never matures into cash. Benefits of investing in cash in a subsidiary depends on the ability of the subsidiary to generate profits and cash to support the parent company's operations. Intangibles are long-term assets with legal rather than physical definition. They may never mature into cash. Intangibles include things like research and development patents, not-compete covenants, and trademarks. Now, going back to the Coinbase balance sheet, you can see here that really on a balance sheet, cash is king. You want to see a company that has assets that greatly exceed their liabilities. You want to see the liabilities or any debt on the balance sheet primarily focused in long-term debt and not short-term obligations. And you also want to see, again, cash is king on the balance sheet. You want to see cash and cash equivalents being very high. Again, that's what we see here, $6 billion in cash and cash equivalents. This is a pretty solid balance sheet. And again, this is only useful for people who are investing in equities. Maybe, obviously, if you're watching this video, you're probably in the crypto space. But maybe you have a proclivity for investing in equities specifically within the crypto space. And that'll actually give you a little bit of exposure to crypto while holding an equity. I can't really, I'm not an equity guy, but that is an option. Me personally, I'd rather just hold Bitcoin. But if you wanted to invest in equities within the crypto space, then you're going to need to know how to read a balance sheet and examine companies' cash flow. I may do a video on cash flow analysis at a future date, but right now I just wanted to cover the topic of reading a balance sheet. And I hope you guys found some value from this video. If you did, just leave a like down below, subscribe to the channel, and I'll catch you guys in the next upload.